The bond bull market for 30 years. The stock boys have been saying the bond bull market's going to be over. For 30 years, it hasn't ended. Might it end? Might it be over? It's hard to say. It's always hard to say. Matt Phillips is here, though. Matt Phillips is a bond reporter. You are the guy with the, we go to, you have the big bond history book. You wrote a story saying the bond bull market might be over.
Well, I'm only saying it because other people out in the market are saying it.
You're reporting what you hear.
That's right.
That's what a reporter does.
That's what we do.
All right.
And you don't advocate for bonds, you just report them.
Right, exactly.
And
but
the facts are, it's been a 30-year rally.
Let's talk about the facts. A 30-year rally.
Yeah.
Why do people think that it might be over?
Well, because there's been a 30-year rally. People are taking a look across a spectrum of asset classes, and they're saying, you know, valuation, it's kind of a simple concept that's behind this. It's valuation matters, especially when you buy. You don't want to buy too high. You make your money to a large extent by buying things that are cheap and waiting. And you can say after 30 years of price increases, you know, because interest rates go down, prices increase for bonds. After 30 years of price increases, it can be hard for bonds to keep going higher, especially when there's not, you know, mathematically, there's only about 200 basis points left before rates go to zero. They can't go negative.
But the other side of that equation is that there has to be something pushing stocks higher.
Right, right.
And stocks have to be cheap. So do you have both those conditions?
Well, they're not expensive. That seems to be what people are saying. Stocks, they're looking sort of affordable. You know, basically, I think the PE on the S&P 500 is around 13, 14, something like that. So not a screaming cheap buy, you know, like they were in March of 2009, but much more affordable by comparison to bonds.
100% rally in 3 years.
Right.
You have to start. I know the PE, and I love the guys. Forget the PE. 100% in 3 years with profit growth slowing down, profit margins probably peaking.
Right.
You know,
well, these guys
there are questions around the stock market.
Absolutely, but they're talking about, most of the people we're talking to are always taking a long-term view, right? So they're saying, if we're betting, which is what we're doing in the financial markets with our money, if we're betting over the next 10 years, you know, people feel much more comfortable saying stocks are going to be the asset class that wins over the next 10 years. Of course, for every individual, it's different, right? Like, you don't get...
And of course, they've been saying that for 30 years.
Right, so there's huge skepticism. We've seen people pouring money into mutual funds that are bond focused for ever since 2008, right? And they've sort of, even in the face of, you know, 100% rally since March 2009, people have shrugged this off and just said, forget it, I'm going into bonds. And that might be part demographics, part people preparing for retirement. So there's a lot of things going on, and you only get one shot at retirement, so you're not going to, like, you know, if you're going to be dead in 10 years,
you know, he's right about that.
If you're going to be dead in 10 years, you know, in the long run, we're all dead, right?
You know, one thing you point out in your story is that there's a few prominent people who've come out and said, now's the time to get into stocks, Goldman among them. Yeah. It didn't have a really big impact on the market. Why is that?
Well, you know, I think it speaks to a lot of what you said about how far stocks have come, and people are thinking about a lot of, in the short term, anything could disrupt the market. I mean, we're talking about China a little bit more. You know, their decline in demand for commodities out there has hurt some of the big name blue chip stocks like Caterpillar and Alcoa recently. So there's anything that can kind of disrupt in the short term. They're taking, Goldman especially, UBS, they're just taking long-term views on relative value of stocks and bonds. They're saying, if I was a betting guy, I'd want to be in stocks, overweight stocks.
Do you think, too, and maybe this is something I just not even answer, but think about more like, the last 3 years, last 4 years have been such a screwy time.
Right.
Do you think that, we could probably extend this to all assets, that the fundamentals have been so destroyed that it is going to take us a while to figure out what the real fundamentals are?
Well, it's kind of interesting, because if you think about historically, like when the bond market, you know, went into a bear market the last time, it was when the Fed was heavily involved in monetary policy. It was World War II. You know, the Fed was essentially monetizing the debt to pay for the war effort. And then we had a bond bear market from 1946 till 1981. So these things tend to go in a real long-term cycles. But when the last time the bond market went into a bear market was after the Fed had been pushing the prices very high for a while. So you could make a historical argument that there's something similar going on now, thankfully without the carnage of World War II, but also a crisis.
See, that's why we got this guy, right? He's got the big book of interest rate
Facts at his fingertips.
He does. It's unbelievable. All right, Matt Phillips, thank you very much.
Thanks,